A derivative is a financial contract whose value is derived from an underlying asset. Okay, like a stock, bond, commodity, currency, or interest rate. You're not buying the asset itself, you're buying a contract that bets on what the asset will do. So rather than getting a stock, you're taking, rather than taking like a position on a stock, you're taking a position that the stock is going to go up. So it's a derivative of the stock. Think of it like a side bet. Two people watch a horse race and bet between themselves on the outcome. No horse changes hands, just money based on what happens. But then you're like the person who's taking a bet on who of those two people is going to win. Is that the derivative? Common types of derivative. Futures, a contract to buy, sell something at a set price on a future date. So this is the common one that I've heard about. Farmers locking in wheat prices. So when a farmer decides to grow a crop, he will try to set up a futures contract, which is okay. It's going to cost me X to produce Y, therefore, I'm going to create a futures contract that I will sell for more than X. And that way, no matter what happens in the wheat market, the farmer makes his profit because he's set the contract already. Now, if wheat prices are higher than the set amount, then the person offering the contract made a profit. And usually, for the security of knowing you'll have a specific price come harvest time, that price is lower, from my understanding, like just a little lower than the what the actual expected market price is. But it gives the farmer insurance against a price of wheat shock, because wheat is a global commodity. It goes up and down based off of global supply and demand, kind of like oil. And so I can see how that could be both beneficial to the farmer and beneficial to the person providing the future. Right? Options. The right to buy or sell at a set price, but not obligation. So you don't have to sell, but it's the right to buy and sell. So this is similar to the farmer example. But whereas a farmer is doing something specific for wheat, this is just any other commodity or any other, yeah, like any other commodity, right? They'd have the right to buy or sell at a fixed rate at a certain time. The right to buy or sell at a set price. And so, but you don't have the obligation to sell. So then, if you have an option to sell at a specific price, so if you have an option to sell at a specific price, and the actual price is lower. Gosh, I'm getting this all confused in my head already. So there's two types of options. There's a buy and there's a sell option. So sell confuses me, so let's try buy. you have an option to buy something at a specific price. If the real price at that time is lower, then you would buy at the lower price and you would not use the option. But if the price to buy that item or that commodity is higher, then you are making money by using the option. So that option makes you the difference depending on how much you sell. I assume that there's a limit on like how much you can buy or sell at the option price. But then I just figure there has to be a limit. Swaps. Two parties exchange cash flow. Cash flows, like trading a fixed interest rate for a variable one. Two parties exchange cash. Trading a fixed interest rate for a variable. Okay, like that. And the example is the only thing I can think of for this situation, so depending on, you could set like if someone thinks there's going to be a fixed interest rate, someone wants a fixed interest rate, and someone wants to trade a variable interest rate. Oh my goodness, that is so complicated. Why would you do that? I mean, I guess that these are like things that financial institutions, right? They have all day to sit there and think of swaps that might benefit them. Okay, credit default swaps, essentially insurance against a borrower defaulting on a loan. Okay, derivatives serve legitimate purposes. Airlines use them to hedge against fuel price swing. Farmers use them to guarantee crop prices. Banks use them to manage risk. The problem is they can also be used for pure speculation with enormous leverage. How they contributed to 2008 crisis. The 2008 crisis was a perfect storm, and derivatives were the accelerant. Here's how it unfolded. The housing bubble. U.S. banks started issuing subprime mortgages, loans to borrowers with poor credit. I mean, that's just not a thing to do. That is a bad thing. Often with little or no down payment. The assumption was that housing prices would always rise. We know that not to be true. Mortgage-backed securities. Banks bundled thousands of these mortgages together and sold them as bonds called mortgage-backed securities. Investors worldwide bought them, hungry for yield. Oh, because they're selling, they're doing more loans to borrowers with poor credit that will have a higher interest rate. So when you see a higher interest rate, the gains look better. And so when you bundle them all together into a mortgage-backed security, it's a mortgage-backed security that has a higher interest rate payout. So it looks better than a normal mortgage-backed security. And so investors worldwide bought them because they look better, hungry for the yield. Yeah, okay. This gave banks cash to issue even more mortgage. Oh my God, they just created a cycle. So the investors don't really understand the risk here, right? So you take, from my understanding of it, you take a house. You bundle it with a bunch of other houses, and you essentially create a mortgage-backed security. Because this is all made by subprime or loans to borrowers with poor credit, there's a higher interest rate. So you're bringing in more cash flow. The yield is better. And so investors who look at that yield will pump money into it because the yield looks like it's performing and bringing back more money than their competitors, than loans to not people with poor credit. So this gave banks cash to issue more mortgages so that they could lower their standards and loan to borrowers with even poorer credit. Okay, CDOs. Complexity piled on complexity. Banks then took slices of the mortgage-backed securities and repackaged them into collateralized debt obligations. This is the problem, right? Like, a couple big words get thrown out like this, and they're just like, oh, why? Why do I have to understand this? I don't want to. And that's how they get you. These were so complex that almost nobody fully understood what was inside them, including the credit rating agency that stamped them AAA, the safest possible rating. So they've somehow gave loans to borrowers with poor credit. This created mortgage-backed securities with high yields, and they have packaged it in such a complex way that credit rating agencies were giving them the safest possible rating, despite the fact they were loans to borrowers with poor credit. So the worst people to loan to were getting the highest possible rating. This is not going to end badly. There's no way. There's no way, right? Credit default swaps, the lit fuse. Here's where derivatives turned a bubble into a catastrophe. Companies like AIG sold massive amounts of credit default swaps, essentially promising to pay out if those CODs, so the complexity pile on complexity stuff, defaulted. They collected premiums and thought the risk was minimal. Well, they're looking at the safest possible rating. I mean, doesn't that mean the risk is minimal right there? AAA? That means risk is minimal, huh? So there were companies that sold credit default swaps, promising to pay out if those collateralized debt obligations defaulted. They collected premiums and thought the risk was minimal. So they collected premiums as their cash flow. They thought they were safe because they got the safest possible rating. But the whole thing was built on loans to borrowers with poor credit. So this is where everything went wrong. Okay. But because CDS, oh gosh, so many credit default swaps were largely unregulated, AIG and others sold far more insurance than they could ever pay out. Oh. So they're selling insurance essentially. So this is like an insurance company giving out insurance that they far larger than they could ever actually pay out. There was no requirement to hold reserves. Well, problem. That right there is a problem. Because credit default swap is a good deal if you know you're holding loans to borrowers with poor credit. Like, you're going to take the credit default swap, the AIG, even if it costs you a premium, because you're offloading all of the risk, right? And you know, like, if you understand the risk, you're absolutely going to take it. So this would be okay. They collected premiums and thought the risk was minimal because the credit default swaps were largely unregulated. AIG and others sold far more insurance than they could ever pay. There was no requirement to hold reserves. It was like an insurance company selling millions of fire policies with no money in the vault. Collapse. When housing prices fell and subprime borrowers began defaulting en masse, MBS lost their value. MBS. Let's make sure we know what they're talking about. Mortgage-backed securities. So the ones built on loans to borrowers with poor credit. Mortgage-backed securities lost their values. The collateralized debt obligations collapsed. Credit default swaps contracts were triggered, but the sellers, like AIG, couldn't pay because they're unregulated and they got no money. We're just collecting premiums. Isn't this like right there? That's the level where it's like in my opinion, fraud, right? You're saying, okay, massive, you're making a credit default swap, you're taking on the risk, but you've got no money to handle the risk. Like, fundamentally, this looks like fraud. But, like, unregulated. That's where they get you. That's where they get you. The collapse. Okay. So, the credit default swaps were triggered, but the sellers, like AIG, couldn't pay. Banks that held these assets suddenly had massive holes in their balance sheet. Banks that held these assets, so the credit default swaps, had holes in their balance sheet. Because the same securities were held globally, the damage spread worldwide. Instant. How were the banks involved? Okay. Before we move on, I wanna understand. Ugh. I always do that. Windows 8. Okay, how do I word this? So if sellers like if the CDS contracts were triggers and the sellers like AGI couldn't pay, how did this involve the banks? Wouldn't this just cause the sellers like AIG to collapse? Like, you think this would cause the sellers, the credit default swaps like AIG, to collapse, and then this would collapse the debt, the collaborative debt obligations. And then this would collapse the mortgage-backed securities, and in the end, the loans to borrowers with poor credit is the thing that would collapse, right? Because in the end, loans to borrowers with poor credit essentially owed money to these companies like AIG, but like, okay, I that is, they have made this so complex. They have intentionally piled complexity on complexity, in order to get a good rating, to fuel the system, and it collapsed. Okay, let's see. This is exactly the part that confuses most people. The answer is that the banks were on both sides of the equation. Let me break it down. Banks were the ones holding the ticking time bombs. I mean, in the end, it's the loans, people with poor credit, which are the bomb. And it is the banks which are giving out these loans. Yeah, remember, banks had loaded up their balance sheet with CODs and MBS. So like these are the mortgage-backed security, CODs, collaborative debt obligations, which are fundamentally built up of loans to borrowers with poor credit. The very securities that were now worthless, they had bought protection on those securities through contracts. The banks got played? Is that what I'm seeing here? Like, AIG is offering you protection on your securities, but they have no money. They'll offer you protection in case something goes wrong. Just monetary protection. Oh, like, like, the banks not look at these companies and be like, how are they offering us protection when they have no money? That doesn't make sense. But I guess pretending that they had money kept the gravy train going, right? And that's what it comes down to a lot of the time. Just keep the gravy train going. They're making money. And the taxpayers are the ones that'll have to pay in the end. So they bought protection on those securities, which they know are bad, through the default swap contracts with AGI and others, thinking they were hedged and safe. No. Like, these are banks. They know they're not hedged and safe. They just want the gravy train to keep going because they're making a lot of money. And in the end, if they make something big enough, they know they'll be bailed out by the taxpayer. So it's not their problem if everything goes to shit. So when AIG couldn't pay out on the fact credit default swap, security. So when AIG couldn't pay out on the credit default swap contracts, the bank's insurance turned out to be worthless, meaning the losses on their CODs and MODs, so basically all their securities, were now fully exposed with nothing to offset them. Think of it this way. Imagine you bought a house and took out a separate insurance policy on it. Your balance sheet looks fine because if the house burns down, you're covered. Now imagine your insurance company goes bankrupt. Suddenly your balance sheet has a massive uninsured loss on it. That's what happened to the bank. Ooh. I mean, like, banks are not stupid. They put themselves in this position. Oh, it gets worse. Oh my goodness. The banks were exposed in multiple ways. It wasn't just the credit default swap problem. The banks were caught in several traps at once. They held the mortgage-backed securities, directly on their own books, which were now worth far less than stated. This is because housing prices are going down, right? So their mortgage-backed securities, which are made up of houses, from subprime mortgages, they're just worth less. Their insurance via the credit default swaps evaporated when sellers like AIG couldn't pay. They had lent money to other banks and institutions that were also collapsing, meaning these loans weren't coming back either. They had lent money to other banks and institutions that were also collapsing. So basically, the banks found a money glitch and then realized it wasn't a money glitch and that the money was coming from somewhere, and they had built it on a very, very sand-like foundation because they were not. Because in the end, this is all built off of loans to borrowers with poor credit. Like, you build a monetary system off this, you will have problems. Like, you're gonna have problems. But they were making so much money they didn't care, right? And they had lent to other banks and institutions which were also doing the same thing. They had off-balance sheet vehicles stuffed with these semi-toxic assets, which they were now legally on the hook for. Oh, okay. The intrabank trust collapse, the real killer. Here's what actually froze the global economy. Banks make short-term loans to each other constantly, every single day, just to manage their daily cash flow. This is called the intrabank lending market. They're always lending and borrowing money from each other. I mean, why? I thought the whole point of a bank is you take money that people give you to hold, you lend that money out to what you believe will be a sound investment. And if that money, and because you know what a sound investment looks like, that makes you more money, and then you still hold that person's money and you can give them a little bit of interest, because you're making money, and the difference is the cut you get. Isn't this the foundation of banking? Why does this require me to buy and sell to other banks? I assume they're just like trying to like level off cash flows. Okay, it exists, the interbank lending market. I don't have to understand why it exists. When the crisis hit, no bank knew how much toxic garbage was sitting on any other bank's balance sheet. Probably a lot, because everything had been so opaque and complex. Yeah, the complexity on complexity level, right? So they simply stopped lending to each other entirely. Ooh. So there was an interbank lending system, that the whole market had kind of become dependent on. But then all of a sudden, nobody knew how many toxic loans this institution was holding because of the complexity. It could have just shut down the lending system entirely. It's like if you had a friend group where everyone regularly lent each other small amounts of money, and then one day a rumor spread that one of your friends were secretly broke, but you didn't know which one. You stopped lending to all of them. That's, I mean, if I'm lending them small amounts of money, I don't care about. Okay, but I get it. We're gonna stick with the example. You stop lending to all of them. That's what banks did globally almost overnight. I mean, this is what happens when they just started stacking complexity on top of each other, right? This caused a liquidity crisis. Even banks that weren't insolvent suddenly couldn't access the short-term cash they needed to operate day to day. Ooh. I mean, it sounds to me like you're overstretching. So to directly answer your question, yes, AIG's collapse would have been devastating on its own, but the reason governments had to step in and save the entire system was the banks weren't innocent bystanders, they were holding the worthless assets that triggered the CD, the controlled default swaps. The default swaps contracts in the first place. The banks had used those same toxic assets as collateral for other borrowing. Oh. So they'd used the same toxic assets as collateral for other borrowing. So the write-downs cascaded. The mutual distrust between banks froze credit markets globally, threatening businesses and individuals who had nothing to do with any of it. The scary phase at the time was too big to fail. These institutions were so deeply woven into the global financial system that letting them collapse would have caused a depression potentially worse than the 1930s. That's why governments around the world felt they had no choice but to bail them out. So they built an entire tower on subprime mortgage loans to borrowers with poor credit. They built an entire financial structure on top of it. That structure was shown to have been built on sand, and started to collapse, but governments couldn't let it collapse because it would have taken out banks, the large financial, and that could have caused a depression, and so they bailed them out. That is insane. Like, how many people went to prison for this? Because there's a couple steps here. This one, offering insurance when you don't have money to pay out. Isn't that fraud? The whole piling complexity onto complexity in order to get your safe rating. Like, let me see. This sounds a lot like a scam to me. I need my headphones on. I need to hear the sound. This sounds a lot like a scam. How many people went to prison for this? Okay, I haven't finished the core problem. Let's finish this and then we'll go read how many people have gone to prison. The core problem. Derivatives themselves aren't evil, they're tools. Yeah. Like we've seen multiple times where this can be used to benefit people. A farmer can make yearly plans because he can take a price swap or whatever it's called, a futures contract that guarantees him a certain amount of money at the end of his year, and so he can budget out his whole year and know that this is going to be a profitable thing for him to do, and so then he can start planting and have it all planned out. Derivatives themselves aren't evil. What went wrong in 2008 was a combination of opacity, nobody knew who owed what to whom, which was largely, in my opinion, driven by the complexity on complexity step in order to get the safest possible rating. Leverage, tiny bets controlled enormous sums, lack of regulation, like just the not regulating. Companies like AIG, just not a good idea. Misaligned incentives, banker collected fees for issuing loans they'd never be responsible for. I mean, that sounds like a good idea for the bankers, right? Interconnectedness, when one domino fell, they all fell together. Crisis led to the Dodd-Frank Act 2010, which pushed many derivatives onto regulated exchanges, requiring more transparency and forcing institutions to hold more capital as a buffer. Both good things, assuming they don't make companies to get around that. Let's see, how many people went to jail? Your instinct is understandable, and you're not alone in feeling that way. The short answer is remarkably few people, especially at the top. The numbers: about 402 individuals face criminal charges, including 97 bankers charged with fraud. Of those, 324 were convicted, and 222 were sentenced to prison. I mean, that's actually more. That sounds like a lot. Read the next sentence. It sounds like a lot until you realize almost none of them were senior Wall Street executives. They were mostly small players, mortgage brokers, loan officers, mid-level fraudsters. The more telling numbers for many critics is 0, the number of Wall Street executives prosecuted for fraud directly related to the financial meltdown that left 8.8 million Americans jobless and triggered a $700 billion government bailout. So, no one responsible for this faced accountability. And you think you're going to stop it. You think you're going to stop the next one when the last one has 0 accountability. This is what makes it particularly striking. When Enron collapsed, top executives faced criminal prosecution and served lengthy prison terms. In the saving and loan scandals of the 1980s, hundreds of bankers went to jail. Among those jailed in the S&L crisis were Charles Keating Jr., whose Lincoln Savings and Loan cost taxpayers $3.4 billion, and David Paul, who was sentenced to 11 years in prison for his role in the $1.7 billion collapse of Central Trust Bank. 2008 was far larger and more damaging, yet far fewer people faced consequences. So, what have we learned? It is apparently a good time for financial fraud in the US right now. If you can get high enough, there is apparently no consequences for financial fraud in the US. That is going to create a lot more financial fraud. Why didn't more people go to prison? Several reasons were given at the time. The Holder memo problem. In 1990, the deputy attorney wrote a memo stating that prosecutors should take collateral consequences into account when deciding whether to bring charges against corporations. Oh, yeah. I remember hearing about this. There was like one specific case in the US where they prosecuted a large corporation for doing wrongdoing, and it led to a bunch of people becoming unemployed. And then from that point on, like, the government in the US just didn't have any balls anymore. Like, they weren't gonna put people out of work because it looks bad, which means you can't prosecute you can't prosecute a corporation. Because what if they fire people? Then that looks bad on you. And so the government lost their balls into account when deciding whether to bring charges against corporations. After 2008, this memo drew attention when it became clear big bank executives would not face criminal prosecution. Fear was that prosecuting a bank could destabilize the entire financial system. Prosecutors claimed they lacked evidence. Holder late told CNN, "We simply didn't have the proof. If we could have made those cases, we certainly would have brought them." Complexity was used as a shield. The financial products were so convoluted that proving criminal intent versus reckless stupidity was extremely difficult. Oh. So if you can create enough complexity, the law literally can't hold you to account. That's crazy. Prosecutors needed to prove someone knowingly committed fraud, not just made catastrophic bad decisions. I mean, at some point, catastrophic bad decisions are worth prosecuting. When it costs the taxpayer $700 billion, maybe you should punish catastrophic bad decisions. Regulatory referrals were missing. One key tool used during the S&L crisis, criminal referrals from regulators to prosecutors. Former government official noted these referrals are absolutely essential because they provide a roadmap for prosecutors and argue they were largely absent in the response to 2008. What did happen instead? Banks paid enormous fines, billions of dollars in settlements, but crucially, those fines were paid by the banks themselves, i.e., their shareholders, not by the individual executives who made the decisions. Many of those executives kept their bonuses and walked away well. Other countries did better. Ireland, for example, jailed 3 senior bankers for up to 3.5 years for conspiring to defraud investors. Most prominent prosecution arose from the 2008 crisis there. So yes, many people share your view that the accountability was grossly inadequate. The crisis collectively destroyed over 30 trillion of the world's wealth. Millions lost their homes and jobs, and the architecture of it largely faced no personal criminal consequence. It remains one of the most controversial episodes in modern legal and financial history. Oh, what? 30 trillion of the world's wealth. Because they decided to build a freaking tower off people, off loans to borrowers with poor credit. And they integrated it through mortgage-backed securities and complexity deep into the financial system. And when house prices finally turned, and the loans to borrowers with poor credit clearly became a foundation that was built on sand, the whole system almost collapsed. And and countries had to step in, bail it out, and no one high up faced consequence at all. Zero. The number of Wall Street executives prosecuted for fraud directly related to the financial meltdown that left 8.8 million Americans jobless and triggered a $700 billion government bailout. No accountability. Destroyed over 30 trillion of the world's wealth. How did this affect Canada? Was there anyone prosecuted in Canada for collaborating with this? Like, this is wild. But like, this makes me terrified of private equity, because so much of this stemmed from the complexity step, where they got the safest possible rating because they just used complexity that no one could understand. But in private equity, it's all private. You can't see any of the financial. And some of the things I hear, like they do in private equity, is just terrifying. It is like a much smaller part of the economy than the subprime mortgages were. Obviously, this was a far bigger block in the foundation. Private equity could cause some problems if it's half as full of fraud as I think it is. Okay, this is really interesting part of the story because Canada experience was quite different from the US in both how it affected it and in the limited accountability that followed. Canada was hit, but not as hard. When European and North American banks teetered on the brink of a meltdown in 2008, Canadian banks escaped relatively unscathed. Canada had built a system of large, diversified financial institutions under the watchful eye of a single, strong regulator, a very different path from the fragmented, loosely regulated US system. While the US experienced bank failures, bailouts, and the worst recession since the 1930s, Canada had no bank failures, no bailouts, and its recession was less severe. However, Canada wasn't untouched. Collapse of oil and other Canadian commodity export prices compounded the effects of the financial crisis, and the Canadian economy fell into a recession in October 2008. Job losses hit manufacturing, construction, and export-oriented industries particularly hard, and unemployment rose during this period. Canada's own mini-crisis, the ABCP scandal. Canada had its own derivative adjacent scandal called asset-backed commercial paper. In the year leading up to 2007, investors had piled into asset-backed commercial paper 30-day and 60-day notes that paid interest earned from bundling assets like mortgages and auto loans together. As fear spread that US subprime mortgages would result in massive defaults, new buyers of ABCP disappeared, leaving $33 billion of securities in limbo. The institution most affected included National Bank of Canada. So we had a mini scandal right before the collapse. Regular Canadians, including retirees and small businesses, had unknowingly been sold these complex instruments as if they were safe, simple short-term investment. No criminal prospect, like we didn't really have it. The bailout, there's one more detail that surprised many Canadians. A 2012 report from the Canadian Centre of Policy Alternatives revealed that Canada banks actually received about $114 billion in government support during the recession, a fact that was largely unreported at the contradicted the popular narrative that Canada banks sailed through the crisis entirely on their own strength. So we also paid quite a bit to banks during this period. Like, it's not that they weren't leveraged in this. The bottom line for Canada fared better than most countries because of stricter banking regulations and a more conservative lending culture. Canadian banks never dove as deep into subprime mortgages swaps as US banks did, but they weren't entirely clean either. They did receive significant government support, and as with the US, no individual was ever held criminally accountable. The pattern of fines without prosecutions was very much the same on both sides. Can this happen again, or have they figured this out yet? I do not want another 2008 financial crisis. The honest answer is, I mean, like, okay, I'll say that forever. The honest answer is they've made it harder to have the exact same crisis, but new risks have emerged, and some of the old safeguards are actively being dismantled right now. I mean, they prevent you from stealing money in one way, you just steal money in a different way. It's beautiful. There's always new ways to steal money. There's always new ways to defraud the government. And if you get big enough, you get to defraud the taxpayer. Because the government will bail you out. What they actually fixed. After 2008, the US passed the Dodd-Frank Act in 2010. It was the most significant set of new rules for finances since the Great Depression. From my understanding, they just pass the risk off to other institutions. Like they set rules for specific, like, banks or something, and the banks just pass it off to other corporations. I don't know. Here we go. Stopping a decade-long role of deregulation and setting critical, important new standards. Key changes include stress tests, living wills, derivatives moved to exchanges. This is it. Derivatives were moved to exchanges, but exchanges then do derivative, like, move risky derivatives elsewhere or something. I don't know. Okay, let's see if they cover it. So they could be tracked and regulated, not traded in the shadows. So that's important. When stuff happens with no oversight, private equity, this is where issues go up. The Volcker rule restricts banks from making purely speculative bets with depositors' money. More capital requirements. If something does fail today, we now have a process to follow. Regulators have the legal ability to go in, shut a firm down, and reopen it for orderly liquidation. In 2008, regulators had to make things up on the fly. Okay. But here's the problem: the guardrails are being weakened. This is where it gets concerning. The regulation put in place after 2008 have been under sustained attack by the banking industry ever since, and are being rolled back right now. The failure of Silicon Valley Bank in 2023 was a direct result of the 2018 deregulation that lifted the 50 billion threshold, allowing banks to expand without being subject to the Federal Reserve stress test and other requirements designed to curb aggressive risk-taking. That was a preview of what loser rules can do. As recently as July 2025, House Republicans have begun attempting to roll back significant parts of the Dodd-Frank Act, targeting not just the Consumer Financial Protection Bureau, but the laundry list of banks regulation complaints. Critics of this approach argue it's like saying a single brick can be taken away from a wall and the wall will still stand. But if you lose enough bricks, there goes the wall. New risks that didn't exist in 2008. Even if the old vulnerabilities were still addressed, entirely new ones have appeared. Cryptocurrencies in 2024, meme coins, digital currencies with no intrinsic value, surged from 20 billion to 120 billion in value. This kind of speculative frenzy echoes the pre-2008 environment, just in a new form, and crypto remains largely unregulated. I mean, if you're putting your money in crypto, just understand that there is no intrinsic value. It could all just go to zero tomorrow, and that's that. Like, that could happen. You don't put money into crypto if you need the money. Like, crypto, in my opinion, is gambling for rich people. Buy now, pay later debt. Oh, gosh, we haven't even gotten into that. Companies like Klarna are now bundling consumer debt, including fast food purchases, selling it to hedge funds, arguing the bundle of mortgages in the pre-2008 era. Why? Why are you letting them do this? They're using the same playbook. They just need the complexity now. Okay, who's going to offer the complexity? We need to make this complex enough that we get a AAA rating. That's the next step. Non-bank financial institutions. This, because the non-bank means that they're not under the same regulations. They function like a bank, but they call themselves a non-bank. A huge amount of lending and financial activity has shifted to hedge funds, private equity, and other firms that operate outside the banking regulations put in place after 2000. Commercial real estate. There's a growing debt crisis developing in banking systems worldwide, with vast quantities of bank lending secured on commercial and domestic properties that are increasingly overvalued or at risk of becoming uninsurable due to climate change. I feel like I could do a whole video on each of these. This is woefully short descriptions. The uncomfortable bottom line. You rarely get hit by the bus you're watching for. That's the most important insight. The next crisis probably won't look like 2008. It'll come from a direction we're not fully watching. What does tend to repeat is the underlying pattern. Financial innovation outpaces regulation. Too much debt gets hidden in complex products. The people taking the risks know that if things go wrong, the public will ultimately foot the bill. As long as this dynamic, privatizing profits while socializing losses, remains in place, the conditions for another crisis will always exist. It's just a question of what triggers it next time. That's the uncomfortable bottom line, huh? I mean, maybe it would help if you held the people from the last financial crisis accountable for their actions. Just saying, like, to me, complexity doesn't mean you get to just face no repercussion. But this is the pattern. Financial innovation outpaces regulation. Too much debt gets hidden in complex products. And the people taking the risks know that if things go wrong, the public will ultimately foot the bill. I think this is exactly what's happening in private equity right now. As long as the dynamic, privatizing profits while socializing losses, remains in place, the condition for another crisis will always exist. It's just a question of what triggers it next time. Well, I think I'm going to end it there. This sucks. Not as complicated as I thought it was. Like, I mean, obviously, I have no idea what they did with the complexity piled on complexity crap. It clearly tricked rating agencies. But if a product is too complex for you to understand, you shouldn't be giving a rating, in my opinion. And this is like one of the, obviously stuff went wrong in each of the steps, but this is the big one to me. And from my understanding, like, banks incentivize rating agencies to give it a high rate. Like, I don't know. what they did, but there was an incentive structure there. So I remember hearing about that, that the big rating agencies were highly incentivized to provide these not safe assets with a safe rating. And that is what triggered this, which is what caused the whole, well, housing prices going down is what caused it to collapse. But this is what happened. This is this is the first fault. They gave out insurance, but they had no money in the vault. And so then when housing prices collapse, all of a sudden, oh, you have to pay your insurance now. And they didn't have the money. And then all of a sudden, all the insured assets that are depreciating don't have insurance. Because the companies you've insured them through were just fraud, essentially.